video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel, and this is the weekend's deep dive. Now, on the weekend, we like to come back and re-examine the base case hypothesis of this channel and see if, largely speaking, things are still going according to plan. So as ever, on the weekends, we're going to run through this thing from the top, see if things are still going the way we expect them to go, and most importantly, we're going to continue to try to figure out whether or not we've got a Q1 type top having to be entertained for the likes of Bitcoin, crypto, and the stock market, or whether or not this bull market actually has legs and this thing can continue to run well into 2025. There is a good amount of evidence, I would say, in both cases. I think we can quite confidently support the idea that we're going to see a Q1 top with some of the data. And equally, I also think that we have plenty of data that points at seeing this bull market run into 2025. So it's quite a challenging time. As ever, it's not really about picking the month that we top in. It's really just about extracting the most money out of the market. So all I really care about is staying long until such time as it becomes unreasonable to do so. But as we run through this thing, you'll see that some things have to change to put on the later top. That could certainly occur. Of course, we could see some change. But until such time as we do, then I still think being a little bit cautious here is warranted. So we're going to run through this thing from the top. Starting off with the stock market, the base case hypothesis was at the lows we were too bearish, we'd have a blow off top to all-time highs, and then we would have a big global bear market and recession, and this whole bear market and recession would have a deflationary component to it. We have also long been speculating that once we eventually see the top, whether that's Q1 or Q4 of this year or anywhere in between, this high will likely remain the high as the stock market experiences a lost decade, similar to what we saw here, and here, while the oscillator at the bottom resets. Fast forward to today, and I think we made a good case that we had completed a blow off top and we started to see a breakdown. However, since then, we are still kind of chopping around on this second angle. Now, there's no true top call from Camel until the second angle is lost. It seems only reasonable for me to expect some kind of pullback into the coming couple of weeks. However, if we can resolve to a higher low and then a push off, that for me will be a piece of evidence to suggest this market has a lot more legs and we don't have to entertain the Q1 top so much. I will also be using any higher low here to get underneath additional long positions in the stock market as we continue to catch this trend. And the most important thing is, and for me at least the most exciting thing is, if something like a higher low is to come in here, we will get to set another third angle and look for even more of a parabolic blow off top here. So huge scope for upside capturing of gains here if we can get this in the bullish case. And something we have to watch for here is in the bearish case, of course, what we would see is some kind of chop, a lack of an ability to decisively break above the prior high, and here's the key part, a second angle violation. If this set of circumstances is to show up, then it will look an awful lot to me like that was the real third angle. The whole thing is broken down and it's confirmed by a second angle violation as well. So it's certainly all still to play for. There's no way anyone can tell what's coming next until we've seen either a higher low come in or a second angle violation. But one thing we have been pretty good at so far is capturing the meat of the move. So I'm sure that once we get some kind of setup show up, we will be able to get on the right side of the trade. For Bitcoin, the base case hypothesis was that this cycle would top sooner than expected. We may even see a left translation. I'm happy to say that we can now scratch this off as an idea. This remains the one component that has to be hard invalidated since we have made new all-time highs post-November of 2024, qualifying this current cycle as right translated. Initially, this call was very good. It successfully called the all-time high pre-halving. It enabled us to catch this move off the lows whilst the rest of the market was looking for something much more like this. But by the time we got into this neighborhood, we spent a significantly longer time consolidating this move than I was anticipating. Since we spent so much more time consolidating this move than I was anticipating, we were forced to adapt to new data. So my original call that was something like this had to be moved across. And we have been since working with the expectation that this is the most likely outcome, this schematic here. Now, today is a very special day because Tony has blessed us with an updated version of this chart. And you can see so far, so good, right? It seems that we are working our way up here, hopefully looking for an overthrow of the top of the channel. And if this is to continue to play out, particularly if it is to take on the shape of the schematic down the bottom, then it will look an awful lot to me like the Q1 top is what's in play. So it'll be interesting to see if we start to go near vertical from here, because to me, that will suggest that we have to put that Q1 top on the table. And of course, if we don't see a near vertical explosion from here and we continue to kind of range in here and build a base, perhaps even touch this channel again or undercut it once more, then it's not really going to look like this, is it? And so, therefore, what I would suspect is going to come is another weekly cycle low followed by a double. And if you're unfamiliar with this concept, each one of these blue arrows down here denotes a weekly cycle low. And what you'll notice is once that low is formed, the price, roughly speaking, does a double, okay? Weekly cycle low, double, weekly cycle low, double. And so if we're going to continue to kind of range here up until early March, that will bring us perfectly in line to the timing band to see another weekly cycle low form. And from there, I think we could take the lowest price, multiply it by 2, and that will give us an approximate target for where we should land, which again would give the chart something akin to this in terms of shape. Now, of course, if this is to occur and we're going to have some kind of base build and double, then it, to me at least, suggests what's in play is a later top, more like Q3 or Q4. So for me, the most important thing here is, can we use the price action over the coming weeks to let us know and give us some hints whether or not we have to entertain an earlier top or much more of a base build, and double. As ever, we'll stay open to all possible outcomes. We'll stay unbiased, flexible, and willing to pivot as new data shows up. So for the stock market, I think the message is pretty clear. Some kind of pullback and a buyable dip should be what's coming next. And if so, then we can look to set yet another blow off angle and enjoy capturing the gains from that blow off angle once more, just like how we caught this move. We missed this bit because we went flat after the yen carry trade unwind. We got back in on the pullback and then we caught all of this. So if we get an opportunity to do that once more, just from a slightly different area on the chart, of course, I'm not going to be quick to turn my nose up at that. And for Bitcoin, I'm kind of hoping this is what we get, because if we can run all the way into the end of the year, it makes it easier to sell from a 4-year cycle perspective. And it also gives us a higher top. But the whole time, I'm extremely cautious here that it's not going to take much, okay? A couple of 10K candles on the weekly time frame, and we will be up here for Bitcoin, and it will look an awful lot like this is what's completed. And once more, it will tell me that the Q1 top is something that we should really be taking seriously if that's what is to unfold. The next component of this is if we are going to get a breakdown, right? If we're going to see a bear market and a recession, then I have long been suggesting what we're going to see is a deflationary component to this. Now, this point at the moment has the highest level of contention, and I want to show you this because this is fantastic to me. I consistently make the case the majority of the market participants think this is what's coming next for inflation, and I have been suggesting that they're all wrong, and what we're going to see is a rollover and a continuation of disinflation before ultimately slipping into asset price deflation. Now, for some reason, this really upsets people, but I want to show you a little bit of new data today that kind of says to me, I can continue to stand with this idea for at least a couple more months. Take a look at this poll here, okay? Do you think DT is going to lower inflation? 50% says no, okay? 50% speaking to this. But here's where it's really interesting. Another 27% say he might be able to, but prices aren't going to fall. Only 21% of people are expecting deflation, right? Are expecting to see prices come off. They're expecting to see inflation actually collapse. Only 1 in 5 market participants actually think something like this is potentially on the table. Now, I absolutely love this. If you are the type of person that is calling for a resumption of inflation, sticky inflation, another round of this, okay, then 80% of the market participants out there agree with you. Now, you might not have a problem with that, but I personally do not like to be on the side of 80% of market participants. And again, I make the case that whilst we continuously see these numbers in the likes of PPI and CPI seemingly tick up, they are coming in colder than anticipated. And most importantly, if you don't take the data at face value, which is what the average market participant does, it looks at these numbers and it says, ha, told you it's sticky, right? That's what the average market participant does. They go, ha, told you, this is clearly the base case, resumption of this. But the moment you start to scratch below the surface, it becomes very obvious, okay, that inflation is a lot colder than these headline numbers will have you believe. When we use things like NSA instead of SA, look, we are all the way down here. Massive difference. And whilst this current, 3% or whatever, 3 handle for the PPI and this current 2.9 handle for the CPI headline is making people say, yep, inflation is sticky. The reality is, okay, this is a downtrend. There are wobbles, there are downtrends, there are wobbles, but this is still a downtrend. There is no reason to think that this thing has bottomed out yet. When we look at core month over month, again, lower highs and lower lows. And when we use NSA again instead of SA, massive difference. Core CPI year over year, yes, macro data sets have wobbles. Here's one, followed by down, okay? Here's another wobble, followed by down. Here's another wobble. But I still make the case we are going to see this resolve to the downside. And like I said earlier, the thing that makes me even more confident about that is 80% of people seem annoyed that I even suggest this. So as I've been very consistent in saying, I am willing to tolerate one more perceived sticky print going into next month. And then the month after, I want to see this inflation data start to really turn down. Then I want to see the rest of the market truly caught offside. Then I want to see my comment section morph into, oh my gosh, how did that happen? Who could have seen this coming? Because we've already started to have this pop up before the turn down, okay, in inflation, CPI, PPI. We've already had a pop up and looking for that turn down. Pop up, turn down, just like we see in every occurrence with a recession, okay? Pop up, turn down sharply as recession takes hold. So I've been making the case we've already started to have this pop up. And if we get to the next month's CPI print and PPI print, we can still tolerate one more bit of pop up. But then I need to see this thing turn down. If it doesn't, then I will come back here and hold my hands up and say, I think the 80% of people that think inflation is going to continue to be sticky because Trump's going to print, even though he has no control over the printer. The 80% of the market participants that think this is the base case, even though the current macro backdrop is nothing akin to what we saw back in the 70s, because this was all triggered by a massive oil supply shock. If the data proves me wrong, then I will come back here and hold my hands up and say, okay, I was wrong about that. But I think what we're going to see is this pop up very, very quickly resolve to a downside push. And if that's true, once more, this is another piece of evidence in favor of that Q1 top. I'm also seeing a lot of people talking about how DT is going to demand that interest rates drop immediately. But let's be honest, he does not control interest rates. He has no say over this. I could demand interest rates come down and I will have as much impact as DT will over interest rates. This is for the simple reason that it's the bond market in aggregate that determines the interest rates. It's not even the Fed, okay? When the bond market in aggregate says, okay, we'll buy the bonds and we'll push the yield down here, we'll get a true technical breakdown, then the Fed will follow suit. And you may well see DT take center stage, pump his fists in the air and say, ha, I told you I was going to get interest rates down, okay? But the reality is, neither DT nor Powell can control these interest rates. It is the bond market in aggregate that decides what the federal funds rate is going to be set at. One thing that will be very, very interesting to see if it plays out, though, is if this counter trend bounce, as I've been saying all week this week, resolves to a true technical breakdown. Because if so, again, it tells us we've got another piece of evidence in our favor to suggest that there is more highs left in these markets. Another component of this is if this is indeed going to be in play, if we are going to have to entertain a bear market and recession, then we would expect to see labor market deterioration, wouldn't we? And of course, that's what we've been seeing. Now, again, short-term wobbles, okay, leaves a lot of people to point at this kind of thing and say, unemployment's not as bad, okay, unemployment's improving, maybe. But this is where I want to point to this data and say we need to be open to everything here. Unemployment is curling up. That's what this is right here. Now, it doesn't mean that it couldn't turn down. We could certainly see this reverse trend and start to move lower. If we did, that to me would be a piece of evidence to say, okay, we can stay long for longer. We can start to look for a Q3, a Q4 top. We can start to discount the Q1 top idea. But if this thing continues to curl up and accelerate, then it's going to have all the familiar symptoms of prior recessions. And again, that Q1 top starts to look even more likely. Notice how all of this is occurring, by the way, against a massive yield curve reversion, which is now reverting and accelerating. We're going to get to that in a moment. We've also got the SAM recession rule continuing to make higher highs and higher lows. Again, it does not mean that this thing could not turn down and buck the trend. It does not mean this thing couldn't produce a lower low. And if it did, that would be another piece of evidence to suggest maybe this bull market has legs. Maybe we can continue to run into Q3 or Q4 of this year. But if we get a few more weeks into the future and this thing prints another higher high, then once more it's going to look an awful lot like one of these lead-in phases before the acceleration as the recession takes hold. Notice how we get a lead-in phase, then acceleration, right? Lead-in phase, acceleration, lead-in phase, acceleration. It's the same in every example. And if this thing does not turn down and produce new lower lows, then again, it is going to look an awful lot like that lead-in phase before the acceleration into a Q1 top and recession. So remember, nobody knows, okay? Nobody knows. I know a lot of people think they do, but all we can do is continue to take the data one day at a time. Something everybody knows, however, is that US credit card debt continues to set all-time highs. But it only gets worse from here because the credit card loan defaults are now at 14-year record highs. This is not nothing, okay? This was similar to what we saw back in the GFC. It's also true that delinquency rates of multifamily housing is also at the levels that we saw back in the GFC era. So again, these things can undo, these things can turn down, these things can reverse course. But until such time as they do, I still think it's warranted here to be a little cautious. And you can also see net tenant rent Q over Q change in blue and adjusted tenant rent responsibility Q over Q change in red, also showing a recessionary look, just like back here in the GFC. So again, is this nothing? Can we just ignore this? Does it even matter at all? I would make the argument that all of this to me, combined with everything else I presented today, says to us we might do well to start to be a little bit cautious and respect any breakdowns should they occur. And we've also got the Piper-Sandler recession indicator, once again taking on one of these recessionary looks. Momentum oscillator down the bottom also starting to confirm this move. Once more, I make the case we could indeed see this thing turn down and reverse course. If we do, we can start to put later tops on the table, Q3, Q4, all of that kind of thing. But if this thing continues to accelerate, then to me, it says the Q1 top remains the base case. Lastly, we continue to see yield spreads signal concern for the markets and again put more evidence in favor of seeing a Q1 top. For anyone that doesn't know, everyone gets the yield curve wrong. When the yield curve inverts, everyone jumps up and down and screams recession, and they're wrong. When the yield curve reverts, everyone screams recession, and once again they are wrong, because it is the acceleration as defined by higher highs and higher lows on the weekly time frame that is synonymous with seeing the tops come in. Without acceleration, if we get a reversion and a bull flag, something like this, we can do this indefinitely, no real signs of market tops having to come in. It is the acceleration that is synonymous with seeing the tops come in. Now, when we go over to the charts and we get a zoomed in look at the hard right edge, you can see this thing is starting to morph into acceleration. Now, we've got a chance here. We've got a chance to either start to turn back down or to kind of range in here. And if we do, then we are not setting higher highs and higher lows. Therefore, we are not accelerating. And therefore, it tells us to be open to seeing a bull market that can continue to run for a few months more at least. But if what we see from here is continuation of this accelerative trend, if we continue to set higher highs and higher lows, it would imply that this top in the stocks, instead of forming a higher low, is going to start to do something like this. And if that's the case, combined with the acceleration in the yield spreads, for me, again, it's another piece of evidence that the Q1 top is still the base case. If you're a Q3, Q4 type of bull and you think this bull market's got legs and we're still kind of early, then what you really need to see here from these yield spreads is sideways. Okay, sideways or down, anything like that, and we can say, okay, we can breathe a sigh of relief. There's probably still plenty of space for the market to run. If we're to get some kind of sideways or down in the yield spreads, that would open up something akin to this, where we form that higher low and then look for a new rip and camel to adjust as third angle to here and start to capture this just how we caught the last one, as I said at the start of the episode. And if we come to the 10-year 3-month, which of course is much sharper, you can see, again, subtle tells at the moment that it's not super alarming. Like, hopefully what we can get is a base here. Hopefully what we can get is buyable dips in the stock market. Hopefully what we can do is allow this market room to breathe and continue to run later into the year, because it's much easier to trade a trending market than it is to try to pick a top and go short and then play defensive, okay? It's much easier for me to buy cycle lows and buy dips in uptrends. So I'm by no means championing and hoping for some kind of big acceleration here and a breakdown and a recession. But again, data is data, facts are facts, and we have to be objective here. If this thing is going to continue to morph into acceleration, historically speaking, we do not have long to react before major tops are observed in the likes of risk assets, the stock market, and I would speculate Bitcoin as well. So it's all still to play for here. For me, I really think what we're going to get in the stock market in the more short to medium term is a repeat of this. I think what we're going to get, I think we've already done this. I've been quite patient here deliberately. I think we're going to get a pullback. I hope this resolves to a higher low. I hope we don't get acceleration in the yield spreads. And I hope then I can get long out of here just in the exact same manner that I did back here to catch the remainder of the trend. That's what I'm hoping for. All the while, we'll be cautious to see that if we don't get a higher low come in and a push, then of course we'll have to entertain second angle breakdowns, and I will have to be forced to call the top if that is to be observed. Gold continues to be mega bullish, so happy days there. We are pretty late in this daily cycle, which tells me a quick, sharp flush into a cycle low is due any day now. Me and the members in the members section will be using that as an opportunity to get to full exposure. We've already built about 60-70% exposure via the miners ahead of this move, but we are going to be using any dip here to get to full exposure. We're also positioned via the silver market and a few other positions as well, so happy days there. For anyone unfamiliar with a base case of mine for gold, it's essentially this, okay? I don't think anyone is bullish enough on gold except me. For the Dixie, I'm really thinking this should be a daily cycle low now. I'm really thinking we should be here, and we should be looking for this to confirm with a trendline break in the next few sessions. It would make a lot of sense to me that as that happens, and we get a slightly higher push for the Dixie, we would see that top come in for gold and a bit of a rollover. But ultimately, we are getting into that neighborhood where we should see this weekly cycle top. So I do wonder if we're going to get a lower high here and a failed cycle and then a multi-week decline into a weekly cycle low. And last but not least, Bitcoin. Bitcoin's still refusing to break above the high, which again says to me that we probably have to waste a bit of time into that weekly cycle low, as I've been saying over and over and over again on this channel nearly every day. In case we're wrong about this and this thing is about to blast off to the upside, we are positioned via some crypto stocks, so we'll be able to catch this move regardless of the outcome. But the longer we spend kind of chopping around in here, not making a new high, ranging, the more it suggests to me that what's actually coming is another one of these kind of pukes into a daily and weekly cycle low. And then again, that speaks to having elapsed enough time to find a weekly cycle low and to look for a double to come in thereafter, in line with this chart right here, okay? Elapsed enough time, get to that weekly cycle low timing band, and then off we go in another double from wherever the ultimate low forms. So that's it from me, okay? Continuing to do what we do best, which is sit back, observe the market, wait for some tradable setups, and then get behind them. I'm your boy Camel. I hope you have a fantastic weekend. I hope you're doing well in life, and until next time, take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see, rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the market's key, taking us normies on a bump.